These results represent the fact that we have made good solid progress in the first half. However, there have been a number of challenges which I'm now going to explain what they are, but probably more importantly, what action were taken. The first challenge is that we've noted that the demand for hardware within our customer base has substantially slowed down. Customers traditionally have been purchasing hardware offers, and what we've noted in the last 6 months is a shift of this trend towards customers wanting more cloud delivery. So for example, we've got one particular customer that every year for the last 3 years, we've done a hardware refresh, which has delivered us over £1 million of revenue in a single order. This customer in August this year said, actually, we don't want to take a hardware refresh off you. What we want to do is we want to look at our strategy and consider taking our solutions delivered in the cloud. There have been a number of other customers where we've seen this shift in demand for on-site hardware. Now, what that means to us as a business is that we will be able to bid for the cloud delivery. But for example, if we look at an announcement that we made in July this year, where we won Grand Union, Grand Union was a £1 million contract win based on over 4 years. Now, Grand Union traditionally would have actually procured new hardware offers that would have accounted for something like 600,000 of one-off revenue. So rather than the business seeing that one-off revenue and the impact of that revenue instantaneously in the P&L, what we actually see is that £1 million flowing through the P&L over 4 years. The other area that we've been impacted by is at the end of Q4 last year, we had high demand for our professional services. We had a number of projects ongoing, and that demand during Q1 started diminishing in the fact that customers said, actually, what we want to do is we want to go live with a number of solutions. We want to embed the change in. We want to ensure that we're getting best value out of your solutions. So what we don't necessarily want to do is roll into the next phase of delivery. That came to a head at the end of Q1 this year. And what that resulted in us doing is it resulted in us right-sizing the professional services department. So we made a number of redundancies to reduce our capability of delivering to meet what the demands were within our current customer base. So if you look at the impact of the revenue on those two areas, the hardware, there was an impact of revenue of 2.6 million. Now, the hardware was relatively low margin, so the EBITDA impact was probably 0.2 to 0.3 million. On the professional services, there was an impact of the full year revenue of 1.6 million. And again, the impact of that from an EBITDA perspective was about 0.8 million. The other challenge that we had was that our customer retention was not as high as it's been previously, from the fact that there was a couple of customers, large customers, that indicated that they were actually either terminating the contracts or going to go out and re-procure. So in the case of the termination, this was a government body called Insolvency Services, which actually looked at Castleton and said, actually, Castleton isn't the right sort of business to provide a finance and procurement and payment management system. So they decided to go out and procure a replacement system. So consequently, we've lost that customer. We've had a couple of managed services customers that have gone out to re-tender the provision of service delivery, and both of those we're currently rebidding for at the moment. So if you take those issues, those are the issues that we've encountered in the first half of the year. The business is still, extremely strong. We're still very confident, and we're still confident of our H2 forecast of both revenue and EBITDA. And we're also, equally confident about our FY21 provisions.
I'm now going to talk you through the high-level financials for the period. Revenue of 11.6 million was lower than the comparative period, mainly as a result of the lower product revenues that Dean's already discussed. In absolute terms, our recurring revenue increased from 7 million to 7.6 million, and as a result, recurring revenue percentage increased from 55% to 66%. Our gross margin percentage increased from 56% to 59%, mainly as a result of the lower product revenues and the better quality recurring revenues that we now have. EBITDA at £2.9 million was slightly lower than the £3 million we had in the comparative period. However, our EBITDA percentage has increased from 23.3% to 25%. Our contracted backlog has increased by 5% to £30.1 million from £28.6 million in the prior period, and this gives us good visibility going forwards. Operating cash produced was £2.3 million in the period, at 80% operating cash conversion as a result of the right-sizing process that we went through earlier in the year. Our free cash flow was 2.1 million, up from 1.9 million in the comparative period. And this is after paying out 1.8 million of cash for Deep Lake in January 2019 and 0.8 million for the dividend, which was paid out post the period end.
As I mentioned, the business has made good progress. We did the acquisition of Deep Lake in January this year. I'm pleased to report that operationally, that business is fully integrated into the Castleton family of products. It's executing extremely well, and we're winning new business with that solution. Equally important to us is, in updates I've mentioned about the fact that we've now got the capability to bid for smaller housing associations. I'm pleased to announce that at the beginning of October, we were announced as preferred supplier for the National Housing Federation. Now, the National Housing Federation represents over 800 smaller housing associations, and they went out for a competitive procurement for housing, mobile, document management, and CRM. And I'm pleased to announce that Castleton have become preferred supplier following a competitive dialogue where we beat 10 other vendors. Now, what that means is the National Housing Federation can now procure directly using some of the framework contracts and framework pricing that we've agreed with them. The Australian business is making good progress and has had a good first half year. Our Indian capability is delivering new solutions. As I've mentioned before, it delivered Castleton.digital. I'm pleased to announce that we've had the first sale of Castleton.digital to a standalone customer who's taken that to online enable the tenants to log things like repairs and make simple changes to their tenancy agreement. The Indian operation continues now to create further new innovative solutions, such as planned maintenance. As I mentioned at the last results update, we're merging the software business and the managed services business. It's fair to say that when we originally announced that, we did have a view that we'd complete the merge and the structure and the operational execution by early July this year. It in fact took us slightly longer, and it wasn't fully embedded in the organisation until the end of September. It's now embedded, it's delivering its work, and the whole customer engagement is all about one Castleton engagement, whether that be a software customer or a cloud delivery customer, or in fact what we're actually seeing is more common customers. Obviously, everyone will be aware we paid our maiden dividend of 1p a share in September. We've had a strong first half. We've won a number of cloud delivery projects. So the first one is Grand Union, which is a 4-year deal for the cloud delivery of their infrastructure that was £1 million, and it was a competitive deal. We've also won Suffolk Housing, and another competitive deal. Again, that was cloud delivery. That was a 3-year deal and 600,000. And finally, we won a housing association in Wales. That was a £300,000 deal, 100,000 a year, and that was to provide the co-location of a DR service to that particular customer. So what you see in there is what we mentioned at the beginning was the emergence of more and more cloud delivery. And ultimately that results in the fact that our recurring revenue in an absolute figures has increased from 7 million to 7.6 million. If you look at cross-sell, when we last reported, 50% of our customers took one solution from us. Now that's increased to 52% taking more than one solution from us. So we're starting to get traction there. One of our success stories is the delivery of our brick solution in the cloud. And in the first half of this year, we've added another 27 customers that are taking cloud delivery of our brick solution. And what this does is it creates us a beachhead for customers that have not historically taken any cloud delivery at all. Because once we can show and demonstrate to a customer that taking cloud delivery doesn't compromise security, performance, or integrity, that tends to open the door for other cloud delivery opportunities. Our growth strategy is very much around focusing on cross-sell, continuing the cross-sell work that we've done and the traction that we've got. Cloud delivery, the emergence of cloud to all our customers opens up more opportunity, and also continue to sell the fully integrated solution to our enlarged customer base. In conclusion, the downturn in hardware sales does create the opportunity for increased cloud delivery, which of course will increase our recurring revenue and our quality of earnings. We're obviously bringing new innovative solutions to the market, such as our Castleton Digital that we're gaining traction on. We obviously continue to gain traction on cross-sell, where we're increasing the penetration of our solutions to the customer base, and we continue to get full referenceability on the fully integrated solution set. Overall, looking at the business, the progress that we've made in the first half year, the opportunity that we have good visibility with, we remain confident that we're going to achieve the H2 revised numbers.